Welcome to Business Today, live from New York. I'm Michelle Fleury, and we begin right here in New York, where US markets have opened lower after Israel's overnight attacks on Iran. All of the major indices are in the red. Meanwhile, oil prices have risen sharply in response, up around 8%, as investors fear a wider conflict could disrupt crucial supplies from the Middle East. Around a fifth of global oil production passes through the Strait of Hormuz, a narrow waterway adjacent to Iran. Today's price swings mark the largest intraday moves for major oil contracts since 2022. That's when Russia's invasion of Ukraine sent energy prices soaring. For more on the price of oil and what it means, Gaurav Sharma, energy analyst at Oilholics Anonymous, joins us now. Good to see you, Gaurav, this morning. What is next, do you think, for the price of oil now?
I think where the oil market finds itself is in the precarious position of sort of peeking over the horizon, see what happens next. This kind of spike in prices is to be expected when an event of this magnitude transpires. It's a question of what happens next. The Iranians have retaliated. I think the Israelis are saying that this is a multi-day action that they're going to take. So if this escalates, and somehow we reach a situation whereby which Iranian energy infrastructure is targeted, you will see a further spike of another 4 or 5% in the market. So we're kind of sort of peering over our shoulders, looking backwards, forwards. What is the direction of travel here in terms of what Tehran and Mr. Netanyahu do?
And where does this leave Saudi Arabia?
I think Saudi Arabia has the position of sort of sitting and observing what's going on. It's already upping the stakes via OPEC in terms of bringing more oil back to the market. It's also cognizant of the fact that had this skirmish, had this level of hostilities, let's say transpired, say, sort of 10 years ago, the situation would have been very different, Michelle, because right now we have a lot of non-OPEC, non-Middle Eastern oil out in the market from Brazil, from Canada, from Guyana, from Norway, and especially the United States. So the Saudis are sort of the buffer producers of the world. They're observing the situation and they will be reactive to what happens next.
I like that, the buffer producers. Meanwhile, I want to ask you about some customers. China and Russia, they are notable buyers of Iranian oil. How do you think this leaves them? What do they do next?
At the moment, I think, we are looking at whether the Israelis decide to go for any Iranian energy infrastructure. If, let's say, the skirmish results in some damage to the Karg oil terminal in Iran, then China would be directly impacted because over the last couple of years, more and more so, China has been turning to Iran for discounted, sanction-ridden crude. So were those facilities to be attacked by Israel, the game changes. We could see a wider spike. But right now, there's a fair amount of oil in the market, and that's basically keeping a lid on prices, which could have overshot even more than we've seen today.
Gaurav Sharma, energy analyst at Oilholics Anonymous, thank you very much for joining us. Now, while oil prices are up, stocks around the world are down as businesses brace for the fallout. This morning, global airline stocks are tumbling as Israel's wide-scale strikes prompted carriers to clear out the airspace over Israel, Iran, Iraq and Jordan. Travel and leisure stocks are also falling as Iran's retaliation raises fears of oil supply disruptions, as we were just talking about. So the question is, what does this mean for the global economy? Well, to discuss this, I'm joined by Tali Leisure, Chief Market Strategist at the Wealth Consulting Group. Good to see you this morning. Look, given fears that this action could lead to a protracted conflict, what do you think this does to global growth?
So when the news broke out, Michelle, I immediately thought of that famous quote from Benjamin Franklin. There never was a good war or a bad peace, especially from a humanitarian perspective. But for markets and investors, I think what this means historically is, yes, geopolitical conflict like this can present challenges to risk assets like stocks in the very near term, but longer term, and that's our investment horizon, I think it tends to open up some compelling buying opportunities for patient investors like ourselves.
Okay, some opportunities, but what about when it comes to prices? Obviously, we're talking about the oil price going up today. It is a key input in so many manufactured goods. What could that do down the road to inflation?
So I think it depends where you sit in the world, and from my seat here in New Jersey, United States, we've got an administration and a president with a policy of drill, baby, drill. And I think generally it's important for investors to keep in mind the mismatch between supply and demand. We generally got the case of too much supply and not enough demand. And that might be the case globally. So as an investor, if you weren't already positioned in energy stocks and oil before the US started evacuating workers from the embassies in that area, it might be getting a little late to play that tactical bounce.
And briefly, what does this mean for the Federal Reserve? I mean, increasing tensions geopolitically, surely that complicates their job.
I think it does. And to your point, we'll be watching the tone on the incoming inflation reports. They have not been a problem over the past several months. So if this continues, this trend, and I think it does, eventually over time, this helps bring the Fed, I think, back into the game off the sidelines in an effort to save growth and jobs.
Tony Leisure, Chief Market Strategist at the Wealth Consulting Group in New Jersey today. Thank you very much for joining us.